When we talk about building unbreakable wealth, we're not talking about chasing trends or timing markets. We're talking about positioning ourselves where innovation, scarcity, and economic truth converge. Every crisis, whether financial, geopolitical, or technological, exposes one reality. Fragile portfolios are built on yesterday's assumptions, while resilient portfolios are built on forward-looking conviction. So when I outline 5 assets that can beat any crisis, I'm not simply listing safe havens, I'm revealing the pillars that consistently outperform when the world is under stress, the pillars that ultimately reshape wealth distribution. The first pillar is gold and precious metals. In moments when trust in institutions falters and liquidity becomes a weapon, gold remains the one asset the world instinctively runs toward. Its value isn't dictated by quarterly earnings or central bank missteps, it's rooted in thousands of years of human behavior. During crisis periods, when currencies weaken and markets unwind, gold steps in as the ultimate counterbalance. It doesn't just preserve wealth, it absorbs the shock, and as global debt levels continue to soar, that counterbalance becomes even more essential. The second asset is real estate, but not the speculative, over-leveraged kind. I'm talking about income-producing, utility-driven properties and rates that thrive because people always need places to live, work, and operate. Crises often compress asset prices, but they don't compress human demand. Real estate's combination of cash flow, scarcity, and inflation alignment gives it durability that paper assets simply cannot replicate. When monetary systems wobble, tangible assets with reliable income streams help portfolios stay grounded. And as demographic shifts and urban redesigns accelerate, real estate stands to benefit even in volatile conditions. The third asset is private equity, a segment of the market that proves its strength precisely when public markets panic. Private equity isn't judged every minute, it works through cycles. It has the advantage of flexibility, the ability to buy when others are forced to sell, the ability to restructure when public companies are hamstrung, the ability to innovate without scrutiny from short-term investors. Historically, private equity has not only outperformed public markets over long horizons, but it has performed particularly well in the aftermath of downturns. Crises create mispricing. Private equity captures that mispricing and converts it into long-term value. The fourth asset, private credit, has emerged as one of the most important shock absorbers in modern finance. When banks step back in a crisis, tightening lending, raising hurdles, retreating from risk, private credit steps forward. It offers yield, structure, and flexibility. Direct lending strategies in particular benefit from floating rates, strong covenants, and negotiated protections that traditional bondholders rarely receive. While public credit often gets punished by forced selling and volatility spikes, private credit can negotiate, restructure, and recover without the pressure of daily pricing. It turns chaos into controlled opportunity. And then there is the fifth asset, inflation. Protected bonds, specifically instruments whose principal adjusts with rising prices. When inflation surges, whether from supply shocks, geopolitical events, or policy missteps, traditional bonds lose value. But inflation, protected bonds strengthen. They safeguard purchasing power at the exact moment the world is losing it. In an environment where inflation is turning cyclical rather than episodic, this kind of protection becomes more than defensive, it becomes strategic. These 5 assets together form a model of resilience. They don't rely on perfect conditions, they excel in imperfect ones. They aren't tied to a single macro outcome, they adapt to multiple futures. In an era defined by rapid innovation, high debt burdens, and geopolitical realignments, resilience isn't optional, it is the foundation for future wealth. Crisis is not a threat, it is a filter. And the portfolios built on these 5 pillars are the ones that pass through that filter stronger than before. When people hear the words financial collapse, they imagine chaos, markets spiraling, currencies weakening, institutions scrambling. But collapses don't dismantle wealth, they transfer it. They expose which assets were built on assumptions and which were built on truth. The 5 assets that consistently survive and outperform through collapses aren't accidental winners. They are structurally designed to endure stress, scarcity, and systemic reset. And in a world where cycles are accelerating, debt rising, technology reshaping industries, and geopolitical tensions intensifying, understanding these assets isn't just smart, it's necessary. The first asset is gold, not as a relic of the past, but as a real-time insurance policy against loss of confidence. Financial collapses almost always coincide with currency instability, liquidity traps, or breaks in trust. Gold thrives under those exact conditions. It operates independently of policymakers, political uncertainty, and monetary regimes. When paper assets crumble, gold often rises because human behavior is remarkably consistent. When trust is scarce, people return to what has always held value. And as nations increasingly weaponize currencies and debts reach levels the world has never seen before, gold becomes not just a hedge, but a stabilizer. The second asset is productive real estate, income-generating properties or rates that remain essential no matter how markets behave. Financial systems may collapse, but people still need shelter, businesses still need operating space, and supply chains still need infrastructure. Real estate anchored in necessity, not speculation, becomes a lifeline during turbulence. In collapses, rents may adjust, prices may fluctuate, but the underlying demand remains intact. And because real estate is tied to physical, irreplaceable locations, it naturally aligns with inflation and currency debasement. When money loses value, land and functional property often gain it. The third asset is private equity, which operates outside the emotional swings of public markets. In a collapse, public valuations get punished instantly, usually driven by panic rather than fundamentals. Private equity, however, moves at the pace of long-term conviction. It acquires assets during downturns at deep discounts, restructures businesses that are temporarily distressed, and creates value through innovation rather than sentiment. Historically, the best-performing private equity vintages are born directly out of crisis years because collapses don't destroy opportunity, they expose it. They reveal which companies are adaptable, which technologies are inevitable, and which industries are mispriced. The fourth asset is private credit, one of the most strategically important tools in a collapse. When banks freeze lending or pull back to protect their balance sheets, businesses still need capital to operate. Private credit becomes the bridge. It steps into the vacuum and provides financing with better terms, stronger covenants, and higher yields. Unlike public bonds that collapse under forced selling, private credit negotiates directly, restructures intelligently, and recovers value through disciplined oversight. In collapses, liquidity is king, and private credit is liquidity with strategy attached. It captures returns that public credit simply cannot access under stress. The fifth asset is inflation, linked bonds designed to protect purchasing power when traditional bonds fail. In many collapses, governments respond with aggressive money printing, stimulus injections, or emergency interventions that weaken currencies. Fixed income investors suffer because the real value of their payments declines. Inflation-linked bonds do the opposite. They strengthen as inflation rises. They adjust principal and income to reflect real-world price changes, preserving value in environments where stability is scarce. Their role is simple but powerful, maintaining the integrity of long-term capital. Together, these 5 assets form a crisis-resilient framework. They aren't reactive instruments, they are proactive shields. Each thrives under a different form of stress, whether it's inflation, liquidity shortages, credit contractions, systemic distrust, or market panic. And when combined thoughtfully, they create a portfolio not dependent on predictions, but on preparation. Financial collapses have a pattern. They punish the overleveraged, the overexposed, and the overconfident, but they reward those who understand long-term value, real-world demand, and the importance of assets that operate independently of noise. Survival isn't about avoiding collapse, it's about being positioned so that collapse becomes a catalyst rather than a catastrophe. These 5 assets give you that position. The rich are not preparing for crisis with fear, they're preparing with conviction. They understand that every period of instability reshapes markets, reassigns value, and rewrites the rules of competition. So when they position themselves in assets that appear unconventional to the average investor, it's not because they're guessing. It's because they're reading the signals the world is broadcasting. And right now, those signals are louder than ever. Debt levels are at historic highs, currency volatility is accelerating, supply chains are rear-architecting, and technology is disrupting every legacy model at once. In moments like these, the wealthy don't retreat, they reposition. They rotate into assets that don't just survive turbulence, but use it as fuel. The first asset they're accumulating is gold and strategic metals. This isn't nostalgia, it's a rational response to declining currency confidence and rising geopolitical tension. Gold remains the one asset that acts as neutral money when trust in institutions falters. But the wealthy aren't stopping at gold. They're exploring silver and industrial metals tied to electrification, AI infrastructure, and energy storage. These metals are not only crisis hedges, they're core ingredients of the next industrial wave. When markets shake, scarcity speaks louder than speculation, and the rich want exposure to assets whose value is grounded in physical necessity. The second asset is premium, income-generating real estate properties with resilient demand, strategic location, and long-term utility. These aren't speculative condos or overbuilt commercial towers. These are logistics centers, data facilities, residential rentals, and essential use properties that remain in demand regardless of economic cycle. Even as interest rates fluctuate and financing tightens, the rich understand that functional real estate aligned with demographic and technological trends becomes more valuable, not less. These properties offer stability, cash flow, and a hedge against inflationary regimes, a combination public markets struggle to match during a crisis. The third asset is private equity, a domain where the wealthy are dramatically increasing exposure. They know that crises breed mispricing, and mispricing is opportunity. Private companies are not punished by daily volatility or emotional trading. They are evaluated on fundamentals, innovation potential, and operational transformation. Historically, some of the strongest private equity returns emerge from crisis-era deployments because downturns expose which businesses are resilient, which technologies are inevitable, and which assets are undervalued. The rich are positioning capital into funds targeting AI, robotics, healthcare breakthroughs, and digital infrastructure categories poised to outperform no matter what the macro environment delivers. The fourth asset is private credit, which has become one of the fastest growing allocations among ultra-high net worth investors. When traditional lenders tighten lending standards or retreat altogether, private credit steps in as the liquidity provider for the real economy. This asset class benefits from superior yields, negotiated protections, and structures designed to limit downside during uncertainty. Unlike public bonds, which can collapse from forced selling, private credit adjusts dynamically. It's the blend of stability and high income that becomes invaluable during recessions or financial shocks. While the public sees crisis as a credit squeeze, the wealthy see it as an era of yield-rich lending opportunities. The fifth asset is inflation, linked securities and real return bonds, instruments designed to protect the wealth that others unknowingly let erode. As governments respond to crises with stimulus, monetary expansion, or debt refinancing, traditional fixed income loses value in real terms. But inflation, protected bonds strengthen, adjusting principal and income to match rising prices. For the wealthy, this isn't just a hedge, It's a way to preserve long-term purchasing power in an era where inflation is cyclical, not temporary. These securities ensure that wealth keeps pace with reality, not with outdated assumptions about stable monetary policy. Together, these five assets reflect a clear strategy the rich are deploying: diversification not by category, but by stress behavior. Each asset reacts differently to crisis. Some protect, some appreciate, some generate income, and some seize emerging opportunities. When combined, they create a portfolio engineered not for the calm, but for the storm. While most investors ask, what if a crisis happens? The wealthy ask, how do I grow through it? This is why they're buying these assets now, because true resilience isn't built in safety, it's built in strategy. Every crash, every recession, every market meltdown reveals the same truth. Most portfolios are built for good times, not for reality. Markets don't fall because numbers change, they fall because assumptions break. And when those assumptions collapse, only a few assets consistently rise above the chaos. These aren't guesses or hopeful bets. They're assets with structural advantages that actually benefit from volatility, inflation, fear, and liquidity shocks. That's why they keep winning across every downturn in modern history. The first asset that wins repeatedly is gold. In every crisis, the world returns to the one form of value that doesn't depend on government credibility, corporate earnings, or economic forecasts. Gold is the asset that thrives when trust evaporates. During recessions, financial stress rises and currencies weaken. Gold becomes the counterbalance the system relies on. It doesn't require yield to prove value. Its value is anchored in scarcity, history, and global acceptance. And as monetary policy grows more experimental and debt burdens expand faster than economic output, gold's role becomes not just defensive, but essential. It's the stabilizer at the center of a storm everyone else is trying to understand. The second asset that wins consistently is productive real estate. Crashes can change valuations, but they don't change human need. People still require housing, businesses still operate, infrastructure still functions. The key is productive real estate, the kinds of properties that generate steady income, support essential activity, and align with long-term demand trends. Residential rentals, logistics centers, data storage facilities, healthcare properties, these don't collapse with markets, they anchor them. Even when interest rates fluctuate and credit conditions tighten, real estate tied to necessity often strengthens because of its cash flow, its tangibility, and its natural alignment with inflation. The third asset that outperforms in downturns is private equity. Public markets get punished by emotion, panic selling, margin calls, and liquidity spirals. Private equity escapes those pressures because it isn't priced minute by minute. Instead, it operates on long-term transformation, innovation, and disciplined capital allocation. Historically, private equity vintages launched during or immediately after recessions deliver some of the strongest returns ever recorded. Why? Because crises expose inefficiencies. They reveal undervalued businesses, distressed but fixable assets, and emerging technologies that legacy institutions ignored. Private equity steps in, restructures, rebuilds, and captures value the public market is too scared to see. The fourth asset that wins in every downturn is private credit. When recessions hit, banks get conservative. They tighten lending, raise requirements, and restrict access to capital. But businesses still need funding for payroll, inventory, expansions, acquisitions. That gap is where private credit thrives. It offers structured loans with higher yields, stronger protections, and negotiated terms built to survive turbulence. While public bonds can collapse due to forced selling or liquidity shocks, private credit is insulated from those emotional cascades. It adapts through direct negotiations, restructures intelligently, and often recovers principal far better than public debt markets. In downturns, access to capital becomes scarce and scarcity fuels returns. The fifth winning asset is inflation-linked bonds. Crashes aren't always deflationary. Many trigger monetary responses so aggressive that inflation becomes the aftermath. These bonds adjust with rising prices, preserving purchasing power when traditional fixed income loses real value. When currencies weaken, when governments print to stabilize markets, when interest rates become tools instead of signals, inflation-linked securities protect the real value of wealth. This is why they repeatedly outperform in cycles where inflation reaccelerates after stimulus-driven recoveries. They don't guess the future, they adapt to it. Together, these five assets reflect a strategy based on behavior, not prediction. Each one responds differently to crisis. Gold protects against trust failure. Real estate defends against currency decay. Private equity capitalizes on mispricing. Private credit thrives on liquidity gaps and inflation. Linked bonds safeguard purchasing power. When combined, they form a portfolio that doesn't fear recessions or crashes, it uses them. The most successful investors aren't defined by how they perform in booming markets. They're defined by how they endure and accelerate during downturns. These five assets win again and again because they're built for the real world, not the ideal one.